Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. Our show today is brought to you by Commercial Agent Success Strategies. Check it out. Look, if you're a residential agent, commercial agent, or you have friends that are commercial agents, they want to get these videos. Learn more at commercialagentsuccess.com. Well, today we're calling the show Market Timing View from New York. Aren't we always kind of considering the market, the cycle, the timing, what's going on, what's going to happen in the future so we can make decisions, right, on real estate, developing, leasing, buying, selling, borrowing, lending. Well, let's find out a view from New York. Please welcome my guest. It's Bob Knakal. He is chairman and CEO of BK Real Estate Advisors. Bob, good to see you again.
Michael, great to see you and great to be on your show. Thanks so much for having me.
Well, thanks for doing it. And I think most of my audience are going to know who you are, but Bob has sold a lot of buildings in New York, and he's done some stints with Cushman. He's done some stints with JLL. He's on stages all over the country. In fact, I was just on stage with you at the C5 Global Summit, CCM down in Florida, and that was a lot of fun.
Yep, absolutely. That was a lot of fun. Big crowd, good vibe in the audience, and always great to hang out with real estate folks. That's for sure.
That's right. And then the Fed announced a 50 basis point rate reduction while we were there, and that was kind of fun. Well, let's get your view. I mean, it's interesting. You've been in commercial real estate brokerage there in New York for many years, since 1984, and you've certainly seen a lot of cycles and what's happening in various cycles. Here we are at the end of 2024. We have 2025 about to start. Obviously, there's been a lot of transaction volume reduction of probably roughly 50% around the country since the Fed started this rapid rate increase. Now they've been coming down. It seems like the market's kind of excited. What do you expect to see for transaction volume moving forward in 2025?
Well, Michael, it's a great question. I think we are headed into unprecedented times in New York, and I would imagine that's probably the case in other markets around the country. But what I will tell you is, I was on CNBC back in February, and I said at the time that in 2025 we would have the biggest sell-off in the history of New York City. A lot of people gave me a lot of grief for saying that, doubted it. If you looked at the first quarter activity this year, sales volume was essentially flat from last year. After the second quarter, volume was tracking to be up about 30% from last year. After the third quarter, it was tracking to be up about 60% from last year. And I believe that by the end of this year, volume will be up 80 to 90% over last year. And I think what we're going to have in 2025 is for the first time ever in the history of New York, we are going to have two sectors of the market very, very robustly competing at the same time. And that's going to be a group of discretionary sellers and a group of non-discretionary sellers. We've never had that happen simultaneously. Normally, in good times, you have discretionary sellers that are taking advantage of the market. In bad times, you have non-discretionary sellers that have to sell. Today, because this correction has been so different from any of the other four major corrections that we've had in New York, where every property type was going down in value just to different degrees. Today, we have different product sectors are moving in different directions at the same time. We have our retail sector, industrial, land, and hotels are actually doing really, really well. And so folks that have been wanting to sell over the past several years but haven't been able to will finally be able to sell. And then we have sectors like the multifamily sector and the B and C office sector here that are really challenged, where we'll have a lot of folks who have no choice but will have to sell because they won't either have the capital to effectuate a cash-in refi or will choose not to put that fresh capital in. So we've never had this dynamic before. So I think it's really going to be an unbelievably robust year in terms of transaction volume next year.
Yeah, that's great to hear, and we're seeing it. Our November listing volume was the highest month of new assignments that we've ever had at our firm here in the Southeast U.S. at Bull Realty, and it's really good to see after such a lackluster transaction volume over the last couple of years. And you mentioned non-discretionary sellers, and a lot of those are office owners, right? That market has really taken it on the chin. And so I want to get your view of the office market there in New York.
Yeah, well, it's a really an interesting market and a lot of neat stuff going on. But you know how much I love statistics, Michael.
Mm-hmm.
So just want to give a little bit of numerical backup to what I said about the sell off, and then I'm happy to get into the office sector. But if you look at Manhattan as a microcosm of the New York City market, south of 96th Street in Manhattan, there's 27,649 buildings. The average turnover of that stock over the past 40 years has been 2.6% annually. And interestingly, it was 2.6% at the end of the 80s, at the end of the 90s, at the end of the noughts, and at the end of last decade. It's been remarkably consistent. And the lowest the turnover has ever been was in 2009 during the GFC. It hit 1.2%. The highest it ever was 4.3% in 2012 when everybody was rushing to sell to beat the 3.8% capital gains tax that was buried in the healthcare law. I believe that next year we're going to see turnover in the 5 to 6% range.
Wow.
So by far the highest we've ever had. And one of the big contributing factors to that is going to be office building sales. And I think it's important. You can't really paint just like you can't paint the entire investment sales market in New York with a broad brush. You can't paint the office building sales market with a broad brush either. The Class A new construction market is doing relatively well. Values are up, tenant demand is strong. Seems like you can rent space for triple digits per square foot, regardless of where that building is. And so that sector is pretty healthy. It's really the B and C buildings that are the most challenged. And so what we're seeing in that sector is that vacancy is very, very high. I mean, in aggregate, we had about 100 million feet of vacant office space in New York. There's only 6 markets in the United States that even have 100 million feet of office.
Right.
We had 100 million feet vacant. There's now about 93 million feet vacant because 7 million feet is in the process of being converted to residential. But I think what we're going to see in the B and C office class is that a number of folks are not going to be able to refi and are going to have to sell. The competing building across the street is selling for half the amount of the debt that the building on the other side of the street has. Impossible for those buildings to compete. It's what economists would refer to as a negative feedback loop, and they're just not going to be able to get tenants. So I think what will happen is this B and C class of office building in New York is going to disaggregate into 3 different buckets. There will be a bucket that will be upgraded and remain office. And we need that because every single office occupying tenant in New York can't pay $250 a square foot in a new building. There will be a big slice of it that will be converted to residential. And there's a number of policy changes that are making that conversion a little bit more economically feasible. And then there's a third bucket that will be demolished based on the fact that that values are getting so low and new zoning changes are going into effect in certain areas that are going to make it absolutely feasible to demolish buildings and build new buildings. So it's like we're not oversupplied in the office sector. We're under demolished in the office sector today.
What do you see there in New York for trends for back to work? How many of these companies are getting folks back in the office?
Yeah, well, I think New York is doing probably better than anywhere else in the country that I've heard. And my perspective is very, very myopic. I only work in New York, so I just hear these things tangentially. But I know that office, back to work is up to 75-80% of what it was pre-pandemic. So I think that is probably leading the charge nationally. And people want to get back to work. I personally think it is really important to be back in the office, particularly for young people. I think the folks who have really suffered the most during this whole work from home thing were younger folks who are trying to learn their respective businesses. Very hard to learn a business on Zoom calls. I think, I know over the course of my career, I probably learned more and picked up more overhearing conversations in the kitchen, getting a cup of coffee, or in the men's room even, overhearing conversations. And, you need to be in the environment to hear things. And you may hear a phrase or somebody say something, you don't know what that means, and you can go over and ask them. And, the learning curve is very, very important to get up that curve as quickly as possible. And I think you do that in the office environment much quicker. And then if you're talking about company culture, very, very tough to promote a culture and a sense of belonging when people are not in the office and don't feel like they're part of something.
Yeah. Yeah, I like it. You're hiring someone, you say, you're going to love our people, you're going to love our culture, but you're never going to see them. You're never going to actually meet them. So,
right.
That is interesting. We certainly see a lot of back to work, and it seems like employees and employers are really seeing the impact of it. It's just taken a while. I think the office market bounces back faster than we think. Some people think it's really kind of dead forever. But Bob, I want to get back to something else. We started the show, you were talking about expectations for 2025 and more discretionary sellers, non-discretionary sellers, more properties going to market. What would you say to buyers for 2025? How should they look at the timing where we are in the cycle right now?
Yeah, I think that this is the best buying opportunity that I've ever seen. And up until about 9 months ago, I had said for decades the best buying opportunity I ever saw over the course of my career was during the savings and loan crisis in the early 90s. Seemed like everything was so cheap, and it was a fantastic time to buy if you had the capital and the courage to do it. And I think now we are at that same level. We've had, we went through the savings and loan crisis, the recession in the early 2000s, the great financial crisis in 08, 09, the great slog, which we had here in New York from October of 2015 through April of 2021, where the number of buildings sold dropped by 54%, the dollar volume of sales dropped by 56% over that period of time. We're in a situation now where, we have buildings that are trading for the same price on a price per square foot basis that they were selling at 20 or 25 years ago. So I call what we're going through right now the great value reset. In the office sector, we're seeing these buildings that, in the B and C sector, they were selling for $700 or $800 a foot a few years ago that are selling for $200 and $300 a foot today. In the multifamily sector, we've had a kind of a triple header of headwinds that have impacted that market. We have a very, very archaic rent regulation system here in New York. The rent laws changed very, very profoundly in June of 2019 against the interest of owners, really clobbered property values. Then we had the pandemic. Then we had the interest rate situation. And, values in that sector are off very, very significantly. So, in that sector, we're seeing also great buying opportunity if you believe in the future of New York. And that's a big if. I think if you believe in the future of New York, and I always say, never bet against New York City. I've seen people write it off so many times, and it has always bounced back. Our political pendulum has to swing. The people who are buying today, particularly in the multifamily space, believe that the political pendulum will swing. Admittedly, that pendulum is heavier than it's ever been in the 40 years I've been working here, but folks believe that it will eventually swing back. And if you believe in New York and you believe in cyclicality of the market, now is a great time to be buying. And I think, again, what inning are we in, or where are we in the process? That is very, very dependent on what property sector you're talking about. I think, again, the sectors that are doing well are much further into the process. The sectors that are more challenged, I think we're getting towards the middle innings, but not quite at the middle innings of that process. But it really is very, very sector specific.
Yeah, a good point. And I've seen the same thing throughout my career. Contrarian investors really build tremendous amounts of wealth of buying in those downtimes that you mentioned. And it is crazy what I'm selling office sell for. I specialize in selling office in the Southeast, and some of the values and comps and prices, I'm just, I'm like, I wish I was buying it and not brokering it. It's like, but once I represent a bank or a seller, I can't change hats, right? It's just what these properties are worth today. It's kind of crazy. And Bob, you mentioned, you've been in the business 40 years and you've been through these cycles, and, lenders, borrowers, the cost of money, the availability of money has a big impact on commercial real estate. What would you say to lenders today? Here we are again at the end of 2024, about to see 2025 start. We have some rates kind of adjusting, market changing. What would you say to lenders about the timing of the market right now?
Well, I would say that it is an unbelievably great time to be a lender if you don't have legacy issues. I'm actually surprised that there aren't more banks that are starting up today, because if you don't have problems on your balance sheet, it is a fantastic time. Spreads are good. It's very, very conservative. Most people don't think there's a lot more downside risk in the market today. So I think it's a fantastic time. The problem is most of the lenders that are in the market today do have legacy issues, and that's problematic. So, I think if you look at the situation, and that's really one of the other big differentiators between what we're going through today and the corrections of the past. I mentioned that in the past, every property type was going down in value just to different degrees, and today different sectors are performing differently. The other big difference is that lender behavior has been very, very different this time around. And I'll give you the benefit of all this gray hair. Back in the S&L crisis in the early 90s, lenders went through that very long 2 or 3 year foreclosure process, which is what it is here in New York. And took title to properties. They all formed REO departments. The REO department took title to the property and then hired brokers exclusively to sell those buildings. And that, in the upstart for 26 years, I had my own firm, Massey Knakal Realty. We really got our first big boost in the early 90s, getting hired by banks to sell foreclosure REO properties. And that was great business for us. Then you get to the recession in the early 2000s and the GFC. The lenders didn't want to go through that 2 or 3 year foreclosure process, so they hired brokers exclusively to sell notes. And we sold a ton of debt during those cycles. And what we're finding today is that lenders are hiring brokers only here and there. For the most part, they're going very covertly to their best customers, offering them notes at a discount or quietly restructuring debt with the borrower, mainly because I think they don't want anyone looking too closely at what they have on their books. We were selling a few notes for banks when Signature Bank went down. Those notes were immediately pulled from the market. And I think the reason was the lenders didn't want anybody looking too closely at what they really had on their books. And I think, the FDIC is aware of what's going on with the regional banking system. And I don't think it looks too good. And if you look at the way the Signature loan book was sold, I think it was indicative of the fact the FDIC knew there were some troubles there. They basically didn't sell the loans. They sold a servicing contract on the loans, and I think the reason for that was that had the loan book sold at too much of a discount, it would have put several banks out of business overnight. So I think for existing lenders, there still are a lot of issues that need to be dealt with. But in terms of the lending environment today, I think it's a great time to be a lender. I had Scott Reckler on my show recently, and he said that I said to him, Scott, if you had a friend of yours that won $1 billion in the lottery and had to invest it in some way in the New York City real estate market and was looking for yield, what would you suggest they do with that money? And he said, absolutely, they should get on the debt side of the business. I think that is a great area to be investing in today. And I think if you look at so many of the folks who have historically only been on the principal side of the business buying property have formed debt platforms, I think it's to take advantage of what's happening in the market today.
Yeah, well said. And I agree. I think, this might be one of the best times. You might do the safest loans you've ever done right now and most profitable loans. And also, I think it'd be a great time to build relationships with sponsors out there. And you mentioned the banks selling notes, and I do a lot of work in the distressed market with lenders and note buyers and sellers. And one of the things that I see is a lot of these notes are selling way cheap. The banks are really taking some big losses on these notes, and because there's so much risk and so little due diligence available to the note buyers, they've got to put such big discounts. And so I think it's interesting to see what happens moving forward. We're starting to see some banks going, you know what, we're not going to discount that note that much. We're gonna foreclose and see what happens. But another thing that when you mention lenders selling notes, banks selling notes to customers more privately, one of the things that we've seen in past downturns is that could be a problem for the officers of those banks, that wouldn't be considered arm's length. There's not a full process. If you run into that where maybe some bank officers or some folks kind of get maybe in trouble regulatory wise or otherwise for doing something that maybe left a lot of equity on the table.
Yeah, and I haven't seen much of that this time around. I mean, that was kind of the joke back during the S&L crisis, that all of the lending officers from Bank A who made all those loans that were being foreclosed on left Bank A and went to Bank B to be in the REO department, and the lending officers from Bank B went to run the REO at Bank A, and they just kind of switched seats and got on the opposite side of the trade. But I think there's a lot of folks moving around within the industry.
Yeah, and I think it might be hard to be a producer of new loans when you've went through a lot of REO and seen all the problems there. Well, Bob, what would you leave our audience to think about for 2025 commercial real estate moving forward?
Yeah, well, I think the thing that I always take heart in, Michael, is that the market always has been cyclical, is cyclical, and always will be cyclical. And it will come back. I believe very strongly that we're going to see this unbelievably robust trading environment next year. It's going to create tremendous opportunity for a lot of people. Unfortunately, a lot of people are going to lose a lot of money also on the way out. But there's no guarantee that you make money in real estate. But I think it's a great buying opportunity. I think there are fortunes to be made in the next year or two. And I think, if I'm fortunate enough to come back on your show in 2028 or 2029, we're going to look back and say, boy, every investor I'm talking to today says they wish they bought everything in sight in 2024 and 2025, because it's going to look like a real bargain, and folks should be taking advantage of the opportunity that exists today.
Well, I agree. Well said. Bob, thanks for being on the show. Good to see you.
Michael, great to see you.
All right. And thanks for joining us around the country. Hey, please let us know what you think. And if you'd like to know more from Bob Knakal, he's all over social media. He has his own show, The Bob Knakal Show. Look him up. You also probably find him on some stages around the country. Maybe I'll be there interviewing him again soon. Well, thanks for sharing the show. Thanks for watching. And until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty, commercial real estate sales, leasing, and advisory services. Visit bullrealty.com or reach out to me directly. My email is michael@bullrealty.com. By ShareFile, designed with real estate and other highly regulated industries in mind, ShareFile offers secure digital solution to simplify workflow and improve collaboration. Visit sharefile.com. By Commercial Agent Success Strategies, 21 cloud-accessed agent training videos. Learn more at commercialagentsuccess.com. You're invited to subscribe to the show wherever you listen or watch the show. You're also invited to subscribe to a weekly email announcing the show topic and guests at creshow.com. Thank you for watching, listening, and sharing America's Commercial Real Estate Show.